All right, let's dive into today's explainer. We are going to unpack a really crucial chapter in partnership accounting, the departure equation. You know, whether it's a carefully planned retirement or an unexpected, sudden tragedy, a partner's exit isn't just a simple personnel change. It is a massive, complex accounting event. And honestly, handled wrong, the financial shockwaves will literally tear a company apart.
So, here is the absolute most crucial takeaway from this chapter. When a partner departs, the existing partnership deed essentially dies, right then and there. From a legal standpoint, the old firm is completely gone. But, and this is key, the business itself doesn't have to stop. A brand new deed has to be immediately framed by the remaining partners to prevent total liquidation. It's basically a complete reconstitution of the firm.
So, to map out this survival mechanism, we're going to follow 6 exact steps from the chapter: the reconstitution trigger, calculating new and gaining ratios, the goodwill adjustment, revaluation and reserves, settling the account, and finally, accounting for death. Let's jump right in.
Step 1. The reconstitution trigger.
Okay, so the very first thing you gotta do when a partner exits is answer one big question. Exactly how much money are they owed? To figure out who gets what, accountants rely on this sum due checklist. And it's not just about returning their initial capital investment. The final tally has to capture the whole shebang, their fair share of the firm's goodwill, the accumulated profits, any revaluation gains, and of course, their share of profits earned right up to the literal day they left.
Moving on to step 2, new and gaining ratios.
With the trigger pulled, we have to figure out how the remaining business pie is divided up among the surviving partners. And for this, we rely on 2 key metrics. First, the new profit-sharing ratio dictates how the remaining partners are going to split future profits. But to balance the books today, we need the gaining ratio. Essentially, the pie is being sliced into fewer but much larger pieces. To find exactly how much a surviving partner's slice has grown, you just take their new share and subtract their old share. Simple as that.
Now pay attention here, because this highlights a classic stumbling block in accounting logic. Think about it. When a new partner is admitted, the existing partners have to sacrifice a piece of their pie to make room. But when a partner leaves, the exact opposite happens. The surviving partners actually gain a larger share of the future profits, and your accounting must strictly reflect this fundamental shift from sacrifice to gain.
Let's put this into perspective. Imagine you've got 3 partners, Asha, Deepti, and Nisha, and they share profits in a ratio of 3 to 2 to 1. Well, if Deepti, who holds that 2 share, retires, the math is surprisingly straightforward. Unless they specifically agree otherwise, you literally just remove Deepti's slice. The new ratio for the surviving partners, Asha and Nisha, just naturally collapses into 3 to 1.
All right, that brings us to step 3, the goodwill adjustment.
Listen, when a partner leaves, sure, they pack up their desk and take their belongings, but they leave behind the good reputation they spent years helping to build. They absolutely must be compensated for this. As the chapter really stresses for your exams, the standard journal entry requires the gaining partners to debit their own capital accounts. They are essentially buying out that reputation out of their own pockets, crediting the retiring partner's account for their exact share of the firm's goodwill.
Oh, and you definitely want to keep an eye out for this tricky concept called hidden goodwill. Sometimes, a firm agrees to pay a departing partner a lump sum that is actually higher than their carefully calculated capital balance. Now, you might think, wait, is that a mistake? Actually, no, scratch that. It's not a math error at all. It is the implied, hidden value of the firm's goodwill that just hasn't been explicitly recorded on the balance sheet yet.
Next up, step 4, revaluation and reserves.
So before anyone can write any final checks, the books have to reflect cold, hard reality. Remember, a balance sheet is just a snapshot in time. Over the years, property values rise, equipment breaks down, and emergency reserves pile up. We have to adjust for these 4 specific areas: appreciating or depreciating assets to current market value, recording any hidden liabilities we might have missed, and distributing all those accumulated past profits and reserves that the departing partner worked so hard to build.
Step 5, settling the account.
Okay, so calculating that final payout is one thing, right? But actually handing over the cash, totally different story. A business can't always just liquidate its operational assets to pay a retiring partner. So the accounting framework laid out in the chapter provides 3 standard methods. You can pay a full lump sum if cash flows allow, agree to pay in structured installments over time, or, and this happens very commonly, transfer the final balance into a dedicated loan account. And here is a very strict, highly tested rule surrounding that loan account. If the balance is transferred to a loan, the retiring partner instantly becomes a creditor of the firm. According to standard partnership acts, unless a different rate is explicitly agreed upon beforehand, that outstanding loan legally carries a mandatory interest rate of 6% per annum until it is fully paid off. Do not forget that 6%.
And finally, step 6, accounting for death. So, a standard retirement? That usually happens neatly at the end of a financial year when you're already closing the books anyway. But a sudden death? That can happen on a random Tuesday in October. This creates a massive accounting hurdle. You suddenly have to calculate the deceased partner's specific share of the firm's profit from the start of the financial year right up to the exact date of their passing.
Since we haven't officially closed the books for the year yet, we literally can't know the true final profit. So accountants estimate this interim profit using one of two methods outlined in the chapter. The time basis analyzes average profits from past years and prorates it for the months the partner was alive this year. Alternatively, the turnover basis looks at the actual sales figures generated up to the date of death and applies the firm's historical profit margin to those specific sales.
Because this interim profit is fundamentally a mid-year estimate, we can't just use the standard profit and loss appropriation account. Instead, we use a placeholder called the profit and loss suspense account. We are literally keeping the books in suspense until year-end. We debit the suspense account and credit the deceased partner's capital account, which ensures their executors get the estimated profit while keeping the firm's current books perfectly balanced.
So what does this all mean? Ultimately, mastering this departure equation isn't just about passing a textbook exam on this chapter. When you look at how meticulously assets are revalued and interim profits are estimated, you realize something profound. This strict accounting process is the vital, load-bearing framework that saves a surviving business from total financial chaos and legal disputes when a key founder exits. It leaves us with one critical question to ponder. Are your own business structures robust enough to survive the sudden absence of a key pillar? Think about it.